So we're incredibly fortunate to have him here with us today. I'm just going to close my door because there's an echo.
I'm going to disappear because it's hard to live up to a lofty introduction. So.
Yeah, so Bob is one of those guys that has lots and lots of letters after his name. So he's an MBA, he's an FCPA, he's an FCA, but most importantly, he's a really great accountant and business advisor. He works directly with a number of high-producing real estate agents in the city. He's really helped develop the Easy Tax Template for Realtors. He gets it because he's in the family of our industry. Bob's wife is one of those incredibly talented realtors that I just mentioned. So he really understands both real estate and the way taxes and everything work together inside that. So super pleased to have been able to snag him for some time today. As you all know, the whole personal real estate corporation thing kind of, we talked about it for years, and then it just seemed like it came out of nowhere and suddenly became legislation without really a lot of understanding of, is this a great idea for everybody, and should everybody do it? So to date, the Toronto Real Estate Board and OREA have put out some things, and again, it's more kind of the implementation. What I wanted to do was be able to have somebody that could really give us more of an inside look at when is it right, what are the things that we're not being told that have to be considerations when we're thinking about this new incorporation, and what are all the bits and pieces that we really should give some great thought to ahead of just kind of jumping in and doing it. So without any further ado, I present you Bob Gold, the FCA to the stars.
Yeah, to the stars in the realty market. Well, thank you very much, Philip. I appreciate it. And I know a lot of you have probably taken some of the presentations already. I know I sat through the OREA one where Tim Hudak showed us that he will never stop being a politician. Everything with him is like go, go, go. But in fact, one of the things he was touting is something that I'm very impressed with, and that is the flexibility of a personal real estate corporation. But let's go back to the beginning. As Philip said, you've taken presentations and webinars. You've seen some of the details having to do with administration and management and some of the legislation things that you have to deal with regarding RICO, et cetera. I'll touch on some of those, but really, to my mind, a personal real estate corporation is no different than any small business corporation, other than you're working as a realtor in the trading of real estate field. But other than that, it's a small business corporation and you run it the same. But let's go over a couple of the basics. So first of all, what is a personal real estate corporation? This is all about tax deferral. It's not about tax avoidance at all. It's not about creating new deductions. It's just tax deferral. So the trick is that a personal real estate corporation really only benefits you if you earn more money than you actually need in any particular year. So if that's the case, and if you could earn your income in the corporation, there's a much lower tax rate in the corporation. On the first 500,000, it's about 12.5%. But some of you are paying the top personal rate in Ontario, and that's 53.53%. So if you can earn money in the corporation, you pay about 30–40% less in tax for the time being. And I say that because eventually you got to move the money out of the corporation, and that's when it's going to be taxed in your hands one way or another. But when I said there's flexibility in a personal real estate corporation, doctors, lawyers, accountants, we can set up professional corporations just like you, but all we can do in our professional corporation is run our professional practice. You can do all sorts of other things. You can own a rental property, which we wouldn't advise, but some people do. You can do other business. You can do consulting in that corporation. You can do investment. You can effectively even take an existing business, convert it to a personal real estate corporation, and use that to be your PREC. So there's a lot of flexibility that we don't have as other professional corporations or other professionals that can incorporate. Now, in order to do this, some of you may know this already, you need a three-party agreement between the brokerage, you, the registrant, and the personal real estate corporation. I know that some of the lawyers that are incorporating these corporations are not doing the agreement. Some are. I'll clue you in on somebody that's doing everything for a good price. I know that Royal LePage is creating their own agreement that the registrants and the corporations will sign on to. So I'm not sure what you guys are doing, Philip. What's happening at Keller Williams? Are they creating that three-party agreement, or are you dependent on the registrants to create their own?
Right now, Bob, we're still in early days, just kind of examining what the best way to approach everything is. So we haven't come to a regional conclusion yet on what's going to happen, or even inside Ontario yet. So we're still fact checking and trying to figure things out.
The agreement should be pretty basic. It effectively just, it's a basic agreement which refers only to the corporation's remuneration, not any other business you might have in it. And it just, it ties the corporation's remuneration from the brokerage to what would otherwise be your commission. So it's pretty black and white. I want to talk about the legal fees for a second to set this up, because there's all sorts of horror shows. I work with a lawyer named Matthew Ordauer. Some of you might have run into him. I have his phone number, his email if you want it. He's doing real estate corporations and the agreements and everything you would need, the minute books, the articles, everything for like $850. I've talked to somebody earlier today that paid $4,000 to a downtown firm to get the exact same document, and he's missing the three-party agreement where Matthew includes it. So if you're interested, this is full service law firm. He works virtually and under $1,000. So don't get sucked into a downtown firm wanting to charge multiples of thousands of dollars. This is not rocket science to set up this corporation. So keep that in mind. And if anybody wants his information, I'll give you my contact later, and you can just reach out to me and I'll introduce you to him. Now, should you incorporate a personal real estate corporation? Again, only if you don't need all the money you earn. You have to shelter it within the corporation for the time being, until such time as you want to take it out for various purposes. Some people say, my spouse is working or my partner's working. How does that affect my decision? If your spouse or partner is working and they have income that can run your household, then use their funds in the household and save yours for the tax deferral, or save part of yours in the corporation. Let's see, one of the other things you need to think about with a corporation is there's a lot more administration, which we're going to get into. There's a lot more administration than you're ever used to running and maintaining a corporation. Right now, as a self-employed or commissioned real estate person, you file a tax return that effectively lists your income and all your expenses, put that schedule to your tax return, and you're done. For the personal real estate corporation, the corporation has far more obligations and filings, so that's something to keep in mind, and we'll get into that. Now, as I mentioned, what can a personal real estate corporation do? You can earn remuneration trading in real estate, claim all the related expenses that you would claim now. It can earn other investment income. It can earn business income, rental income. Although quite frankly, if any of you have investment properties, your accountants have probably already told you they don't want your investment property in the same corporation as you're earning your professional income, or where you might have other assets or investments. It's good to shelter or protect all the other assets from the real estate, and the real estate from the other assets. The reason we worry about that is liability. Say you had somebody fall down the stairs in your rental property and break their neck, and they got a couple little kids, and they got an $8, $10, $12 million lawsuit on your hands. Your insurance may not cover that. They'll come after all the other assets in the corporation. If that's other investments, et cetera, and even accumulated income from trading in real estate, all of that's at risk. But if you hold your investment property in a separate corporation, there's a good corporate shield between your other assets and the assets of the real estate itself. So it's a risk avoidance circumstance. Okay, what are the costs of a personal real estate corporation? So first of all, initial incorporation, as I mentioned, $1,000 to $4,000. So please don't spend $4,000 on this. You will get a series of documents. You get articles of incorporation, bylaws, and agreements of purchase. Here's a special one, and I've run into this where a lot of the lawyers are not thinking of this. When you start up a personal real estate corporation, you're effectively transferring the goodwill that you have in your proprietorship into your corporation. What's the value of that goodwill? Well, it's almost impossible to tell. And if you don't elect a value, a nominal value, CRA at some point in time could try to tax you on the capital gain of this transfer, the sale of your goodwill to your corporation. So it's very simple to avoid that. There's a one-time election form that you file. The election form designates your goodwill at $1, just a buck. It's not a meaningful number, but the fact that you designated that and you filed the election form, you avoid CRA ever saying that you're subject to capital gains tax on the transfer, the sale of the goodwill. So that's a small detail. Most accountants will think about it. Not all of them will, but I know the lawyers are not, because there needs to be, as well as all these various documents of articles and the three-party agreement, there needs to be an agreement of purchase and sale between you and your real estate corporation, acknowledging the transfer of that goodwill. So it's a simple one-page agreement of purchase and sale. You guys are all used to those agreements. This is just something that we don't want to miss this step. I know the lawyers are not including it. They're not thinking of it, and they're missing the chance to protect their clients if, in fact, CRA says there's value to your goodwill. If you're a realtor that's earning, I don't know, 500, 600, 700, 800, $1 million, $2 million a year consistently, clearly you've got goodwill. So let's not get stuck and miss that opportunity. So keep that in mind. That's an election form your accountant will do. And if he doesn't suggest it to you, you suggest it to him. What about my election form on goodwill? And when you do incorporate, that's worth talking to the lawyers about. I did have a conversation with my friend Matthew about that, and he's now going to include that in his package as well, just to have one more document to solidify this whole thing. Now, as far as your annual costs, I'll tell you that you'll pay about $500 or $600 a year to a lawyer to do the minutes, your annual minutes. And you want to have the minutes because one, they confirm, the directors in the minutes confirm everything that you did during the year, whether that's signing contracts, whether that is declaring dividends. You need the minute books done because it's something that CRA will look for. It's crossing an I and dotting a T, so to speak. You will pay about $55 an hour for a bookkeeper, and I think you need a bookkeeper about 1 day a quarter, which is what I'm finding. That's about $2 grand a year. And the reason I say 1 day a quarter is your corporation has to file its own HST, just like you did as a realtor. But I suggest you do the corporation's HST on a quarterly basis. And the reason I like that is it forces you to do your bookkeeping on a regular basis, and then you don't have any fights with CRA or your accountant at the end of the year. So count on about $55 an hour for a bookkeeper, 1 day a quarter. And then the big one annually is the accounting fees. Accounting fees for the kind of work you need is typically about $2,500 to $3,500 a year, which may or may not be more or less than you're paying now for your personal tax return. It really depends on the complexity of you as a real estate commission salesperson. But for the annual corporation, not your personal return, the annual corporation, say around $3,000, give or take $500. That'll take care of the financial statement that is required and the T2 corporate tax return. The corporation files its own return. It's called the T2. And then your personal tax return would be on top of that. But at this point, you should only be an employee of your corporation earning a salary, so your personal tax return will be pretty straightforward, I would expect, unless you've got other complicated investments in there or lots of trades in stock transactions. Okay, any questions on costs? I know I'm covering a lot fast, but we're all busy. Anything you want to state at this? Anything you want to raise at this point? Anybody? No? Okay, I'll keep rambling. Okay, who could be a shareholder of a personal real estate corporation? So there's really lots of opportunity for income splitting within some restrictions here. First of all, you as the realtor, you're what's called the registrant. And you must own all the issued equity or voting shares. Nobody else in your family, no other contacts can own voting shares. So they can't direct the corporation. They can have the non-voting shares, which would be eligible for dividends. You can have a family trust, which holds shares for a minor child if you want. And the definition of family members follows the Modern Family TV show definition. Anybody that's a family member, stepchild, grandparents, parents, a real Modern Family definition become the family member. So you are the holder of the voting shares. You control the corporation. Family members, minor children through a trust, or adult children, anybody over 18, can hold non-voting shares and be eligible for dividends. But again, there's some restrictions which I'll get to, and that's called income splitting. Let me just stop for a second. I know we don't have any surveys going, but have any of you or many of you incorporated as yet? Phil, do you know if any of them have incorporated yet?
Under the new rules, nobody that I know yet.
Nobody's done it as yet. Okay, so keep that in mind. When it comes to family members, the fact that they'll have non-voting shares, you're not giving up any control of the corporation, nor do you ever have to declare dividends on their shares. So I just say be cautious when it comes to children. I just got a memo that my internet connection's unstable. Have I blocked the clock? Have I ticked out at all? I'm okay?
No, you're good.
Okay, let me know if anything happens. I'll switch the router. Yeah, so family members. I say be cautious with family members. Adult children, they get shares in your corporation. They get married. Part of the family asset could be those shares. The children get divorced or split up. What happens to those shares could be an issue. It could be protected, but you got to go into other documentation to protect them from spouses of children, etc. So I'd say be cautious with income splitting dividends with kids because of family matters, but still there is an opportunity. So how does income splitting work? That's really the issue. So any family member who works for you, like actually works as an employee, if they work 20 hours a week or more, and that's a new rule, it came in a couple of years ago. If they work 20 hours a week or more, you can compensate them by salary. Now it's got to be reasonable salary based on what you would pay a third party for doing the same work. So figure out an hourly rate. If it's a spouse or children that are working 20 hours plus a week, pay them. It's a deduction to your corporation. Money's taxed in their hands as salary, and that income splits to some extent. Now, those family members that are working 20 hours a week, they're eligible to earn dividends, and that's really where the income splitting comes in, because we can pay dividends on their classes of shares, taxed in their hands at a lower rate than salary. The corporation does not get a deduction for the dividends, but it's only paying tax at that 12.5%. But again, it's a 20-hour restriction. Those family members have to work for you for 20 hours a week on average in order to earn those dividends. However, if you are over 65, there's no 20-hour criteria for your spouse. So any of you that are seniors and want to income split with a spouse, you can income split to your heart's content. The other trick with the non-voting shares is you should have, and suggest to your lawyer, that you have multiple classes, class A, B, C of non-voting shares. And the reason I say that is you can have a class for your spouse and a class for your children, and that way you can declare dividends just when somebody needs specific money. For example, you can declare dividends on the children's class of shares if they need tuition for university, and you can declare dividends on your spouse's class of shares if you want to go on vacation. So there's some flexibility in having multiple classes of shares and how you go about income splitting. But again, that 20-hour rule is really important. And a lot of you I know don't have family members working 20 hours a week. So that then begs the question, should you bother giving them shares at all? I would say it can't hurt, because down the road, if you sell the shares in the corporation, they can benefit from the same capital gain exemption that you can. So there may be an opportunity to income split the capital gain. However, I think that's a long shot. Philip, let me get you to weigh in on this. 5 years down the road, I'm a successful realtor. I'm earning $1 million plus a year. I decide to sell my shares in my corporation to you. Are you likely to pay a premium for those shares, or would you mainly go on a referral basis where you pay me some fee on any work generated from my book? How would it really work? Yeah,
the reality would be that you would set up a sort of sliding scale down for referrals. Because we don't know, again, going back to your idea about goodwill, if that agent walks away from their business, how many of the clients walk with them? So the best way to figure that out is really to just base things on future earnings and splitting those.
And that's what I think will happen. So I doubt, quite frankly, although it's being touted by AREA that there's a capital gains exemption opportunity here, I don't really see any of you selling your corporation shares for a big capital gain. It just doesn't make sense. There's no guarantee of future work. It's not like if I sell my book of business, income tax is a necessary evil. You're coming back to us every year. There's something that a purchaser can count on. Let's see. So how are you compensated? How's the realtor compensated from your personal real estate corporation? It comes down primarily to a salary dividend mix, meaning some salary, some dividend, but how do you determine what you need? Well, a main criteria that people like to think about is their RSP. If they want to max their RSP, 2020, the maximum contribution is $27,230. 2021, it's $27,830. But for this year, 2020, in order to be eligible to make that 27,000, you had to earn 151,000 in 2019 because your earned income is based on the prior year. So if you want to make a maximum contribution in 2021, it means your 2020 income has to be 154,600. All right, now we go into the next year, into the corporation. You have to, if you want to max your RSP, you have to take out of the corporation salary of, let's call it round figures, $155,000, which starts to put you up into a high tax bracket, although the RSP will be a deduction against that. But that is something to think about because all your other realtor related commission expenses will all be in the corporation. You're going to have very little or no exemptions or deductions to take except your RSP and your personal deduction. So keep that in mind. Salary dividend mix is important, and any accountant can calculate the tax benefit from mixing salary dividends. Say if you want 200,000 a year, how much would it all be if it was, how much tax would it be if it was all salary? How much tax would it be if it was 155 to cover your RSP and 50,000 to cover dividends? That's how you determine that. The other thing to think about is your Canada pension. As a self-employed individual right now, you will pay the same way the corporation pays, which is effectively double. The max for Canada pension this year is $5,900. Next year is just under $6,400. In your hands this year, you will pay on your tax return $5,944 in Canada pension. That's effectively double your half and the employer's half, because if you're an employee somewhere, you only pay half that in employer. But if as a self-employed individual, you're already paying double. In the corporation, it's the same thing. For next year, $6,400, the corporation will pay half and you'll pay half, but that is a cost, but that means you have to have enough income to generate the max for Canada pension. And you certainly get that at a pretty nominal amount. Certainly you hit that when you go for max RSP. But again, I say you have to think seriously about your needs. A lot of realtors don't put money into RSPs. They put money into investment properties. So in that circumstance, if that's you, you have to think even more seriously about what your salary dividend mix would be, because maybe you only want salary of like 15 grand to cover your personal exemption amount and you're tax-free on your salary, take the rest as dividends. Something to think about. You got to talk to your accountant about that. The other thing I know people talk about, and I saw this on one of the presentations as well, and this is something that's been used in corporations for a long time, and that's dividend sprinkling. And what that means is you earn a lot of money in the corporation, put yourself on a nominal salary, say 75 grand a year, every year. But then you go away on vacation or you have a bad year, because you've accumulated income in the corporation, you can still give yourself a $75,000 dividend and it'd be tax cheaper. And the money's already tax paid out of the corporation. So you can even out your earnings, even though you're taking time off, and by draining the money, the retained earnings, the cash you've accumulated in the corporation in a year that you might otherwise have low income. In fact, you could boost it that year a bit. So there are ways to pay out all that cash you're accumulating, although of course we expect you want to invest that. Okay, a couple more points I'm going to make, but let's just stop any Q&A at this point. Anything on what I've said? Not yet? It's a lot of good information here. Philip, when we're done, I'll send you my speaking notes if you want to share them.
Great. And every once in a while, Bob, if you want to just sort of check into the chat room, I've been answering some questions there that are more sort of brokerage related, but yeah, we've got what's the tax rate we would pay on an individual?
Okay, let's do this. Let me go through my next couple of points, and then some of them will be addressed in there. Yeah. And then we can just address them. Like I have as long as you want.
Cool.
Okay, here's where the nitty gritty of this really is, and that is how do you run a small business corporation? I don't care if you're a doctor, a lawyer, a manufacturer, a realtor, an insurance salesman, you have a small business corporation. They're all the same at this point, and you're all under the same kind of scrutiny by CRA as anybody. So number one, books and record keeping. I'm going to drive you crazy to get yourself a good bookkeeper and stay on top of the bookkeeping. I'm going to suggest QuickBooks Online. All the kids call it QBO. I don't like that, but that's what the kids call it. Bookkeepers are familiar with it. It's well priced. It's easy for bookkeepers to run. It's easy for you to log in online and take a look at an income statement and see how things are looking. It's also very easy to share that file with your accountant so at any time they can take a look and talk to you about income splitting, salary dividend time. Now, should we do it now? So I would say bookkeeping and record keeping are really, really important. And as an aside, your profession sucks at this. You guys do not like to keep good records at all. I don't know why. It's just, it's one of those things that you're busy earning your income, and record keeping is kind of something we should do later. Well, I'm gonna, as I suggested, if you incorporate, have your bookkeeper every 3 months. It'll save you so much hassle down the road. Now, you have to prepare and file a financial statement, a corporate tax return at the end of the year. That's a task you don't have now. You have to remit monthly payroll deductions for your tax and CPP to CRA. That's something you don't do now. Again, your bookkeeper can help you with this. The challenge that I think most realtors are going to have with payroll is trying to determine what should your payroll be, because you have up and down income. So if you put yourself on, say, an $80,000 or $150,000 salary, you may not always have that income available. If you're getting started in the new year, you have a couple of deals closed, you're on 40, 50, 60,000 in commissions, you have some expenses. You don't want to pay that all out at once, because that puts you right into a high tax bracket on the deductions at source. Then if you go into a period, you have big commission income, you have big income, you still, what are we going to pay out? So I see this as a particular challenge, and the realtors I've been speaking to since October 1st, my phone's been ringing about this. What should my salary be? Well, if you want to accomplish that 155 or so for RSPs, and you're just starting to earn income in the corporation, if you don't have a big commission check coming up real soon, how can you take out that salary? This is a conundrum that you have to get over the first hump until you have cash in the corporation. Because if you earn, say, an $80,000 commission and want to take 50 or 60 grand of that out, the tax tables for payroll deductions don't say take out 15 or 20%, which might be how you average for the year. They're going to say take off like 50%. So you got to be really careful with the salary. And this is a conversation you have to have with your accountant or your advisor, how to set that initial salary. But on a monthly basis, the 15th of every month, you have to send to CRA the tax you withheld from you and any employees, not team members. We'll talk about team members in a second. But you and any employees who might be family members, tax and your Canada pension goes to CRA on a monthly basis. You can't be late with that because there's all sorts of fines and penalties. Along with that, T4 forms for you and any employees, again, not team members, but you or any employees, those family members and the assistant that you employ in your corporation, T4 forms for salary, a T5 form for any dividends you declare. So these are things you don't prepare now, but you will have to prepare on an annual basis. And those are due the end of February in a normal year. HST we talked about, I say do that quarterly. Don't wait to the end of the year. It's a pain in the neck. You won't get your bookkeeping cleaned up routinely. And again, that's my favorite pet peeve, is getting your bookkeeping done on a regular basis. So quarterly for HST. On HST, once you incorporate and have filed your last HST return as a self-employed commissioned realtor, you should consider canceling your personal HST number. Otherwise, they're going to keep sending you correspondence. You'll have to file nil returns, either quarterly, monthly, annually, however you're doing it now. So once you have filed that last HST return, cancel your personal HST number, just use the corporation's. I also want you to think about the year end of the corporation. It doesn't need to be December. Most people like December. They think in terms of calendar. I don't care personally. Most accountants would encourage you not to use December because they're very busy. These are small jobs and they don't want to have it, but you know, it's fine with me. But so if you don't have December as a year end, there's two things that I think about when it comes to choosing a year end. One, is there a slow time in your year? If you're a realtor that takes off the summer and goes to the cottage, it might be quiet for you in say June, July, August, might be. That might be a good time for you to set your year end. You can set your year end any time within the first year of incorporation. You have one chance to set it. And the reason I say pick a slow time is because at that time, you'll be able to spend time with your bookkeeper and with your accountant. If you're really busy, because fall is busy for you, you're not going to have time to do these administrative corporate tasks that you need to do. So consider if there's a slow period of the year, that's around when your year end should be. December, if that's convenient for you. But my final trick is to have your year end in the latter half of the year, July through December, because there's a big tax deferral opportunity available to us if your year ends in the latter half of the year. And simply that means I can declare a bonus, a management bonus to you. It can be equal to whatever amount of money you want to take out in the next 6 months after your year end. or if you're doing your year end later in the year, like 4 or 5 months after the fiscal year, it's due 6 months. You have to file those tax returns 6 months after the year end. So if you're doing your work somewhere within that 6-month period, you already know what you've taken out. We can declare that as a bonus to management or as a salary accrual, salary bonus, pay it out normally, but the company, your corporation, will get the deduction for all that 6 months worth of salary right now in the fiscal year, and yet you don't take the tax, you don't pay the tax on that personally till the next year. We can only do that if I've got a 6-month window, because it has to be paid out within 6 months after the year, which puts us into the next calendar year, which affects you personally. So when choosing a year end for your corporation, December if it's convenient, slow time if you can find one, or the latter half of the year so we've got that bonus accrual should we ever need it. Doesn't always come into play, but it's good to have the flexibility of that. Let's see, I told you that the tax filings are due with the financial statements 6 months after the fiscal year end. However, if you owe any taxes, those taxes are due 90 days after the year end. So that's another reason to work with your accountant and your bookkeeper shortly after the year end. Don't wait 6 months. You have 90 days. You also have to pay monthly installments on your corporation based on the prior year corporate tax. So right now you're used to paying quarterly income tax, or pay your personal taxes quarterly installments. Corporations, it's monthly based on the prior year. So in this first year that you're incorporating, you don't need to prepay any installment tax. You should be aware you're going to have it. So figure out with your accountant what you should put away for tax corporately. But you don't need to remit it. Once you file that corporation tax return, you'll get assessed, you'll get the bill, although you could pay it online, of course, once you file. But they'll also then advise you what your quarterly payments or your monthly payments will be, as will your accountant when he does the work. We all use the same tax reporting packages, and that reporting package will tell you what your monthly installments should be for the corporation. So again, you didn't have that burden before, but you have it now, monthly installments for the corporation. And there's penalties and interest, penalty interest for not paying those things on a timely basis. So here's a couple little tricks that you never would have had before. Right now, you've all got office equipment and cell phones, maybe they're capitalized, computers, office furniture. If these things aren't completely written off as yet in your own hands as a realtor, you have a book value and your accountant's been depreciating those things. You can take the book value of your office furnishings, your computer, let's say it's, pick a number, $3,500 is the book value or the undepreciated book value, undepreciated capital cost in your corporation, or in your own hands. You can transfer by way of a simple bookkeeping journal entry that $3,500 net book value that was on your last tax return, put that into the corporation by way of a journal entry. It's all you need, no bill of sales, no HST, nothing, just a journal entry, put into the corporation. It now sets it up asset. So now that $3,500 is there, eligible to be depreciated at whatever the rate would be, say 20% for office equipment. And the corporation owes you the $3,500 because you've transferred it in for the benefit of the corporation. You haven't made a gain on it because you've transferred in at book value, so you can take out the $3,500. So that's something to think about. Most people, most accountants don't think about those small dollars, but I figure if we can get $3,500 into your hands tax-free, hey, it's $3,500 that is tax-free. Corporation will get the tax deduction. Along that same line, there's also home office costs. Most of you are probably taking a home office cost already on your personal tax return. Now that home office cost can be taken by the corporation. So let's say the calculation worked out to be $1,800 a year if you took your mortgage interest, property taxes, utilities, and insurance, took the percentage of the square footage of the house. You got a 9-room house, took 1/9 as your home office. And they say that worked out to $150 a month as a number. You can now take that money out of the corporation, pay yourself a check every month for that $150, $150 in your pocket, tax-free. Corporation gets a deduction for it, and it does not affect your principal residence exemption at all because you're not making a profit, you're not renting out to an outsider. So you can get into your hands the book value of your fixed assets for depreciation purposes, and you can get into your hands the monthly rent that your corporation's going to be paying you. You can also take that out at the end of the year, or don't take it out. You can let it sit there as a shareholder loan, that monthly rent, and let it just accumulate until you got 5, 6, 8, 10 grand a few years down the road. Take it out all at once. The corporation will get the deduction regardless. All right, so my final point on this, I know there's a lot of things I could talk about in running and managing a corporation, but quite frankly, it's just a formalization with the administrative tasks of what you're already doing. So my final point is, should you bother with a personal real estate corporation? And quite frankly, my note to myself says, depends on your personal circumstances. If you are a high income earner consistently, the answer is likely yes, but you can't make this determination on your own. This is something you have to work out with your advisors, whether it's a wealth planner you work with or your accountant. You need to look at this as a small business corporation and look at it that way. It doesn't matter that it's a real estate corporation, except for the administrative tasks, it's no different than anything else. And before we get to the Q&A, Philip did mention something called the Realtor Easy Tax Template. We created this a couple of years ago. There's probably a few hundred realtors in the city that are using it now across many brokerages. We don't charge for it. If you want it, I'll send it to you. It's an Excel template that it's not for corporations per se. It's not a bookkeeping package, but it allows unincorporated realtors. It gives them a template to calculate all their expenses neatly and concisely and calculate your HST on a routine basis. And I tell people use this or give it to your bookkeeper once it's completed, because you can complete it real easy on your own. And if you're paying an accountant now, let's say pick a number, $1,500 to do your tax return, this will save them a lot of time, and they can spend more time advising you as opposed to preparing your tax return. So you get more value for your $1,500 if you give them a document that's completed that they can start with. So we call it our Realtor Easy Tax Template, and I'm happy to send it to anybody that wants it. Robert at bennettgold.ca, and I'll just send it to you. Should we go through the chat Q&As here?
Yeah, so Robert, one of the things that's coming up a lot is we know we can't hire realtors through our personal real estate corporations because we're not a brokerage. But can you, inside your real estate corporation, can you hire administrative staff?
Yeah.
Pay them.
You can hire anybody it takes to run the business. Absolutely.
Right.
And I alluded to team members before. You can't pay team members because they're realtors. They could have their own PREC if they want. Otherwise, they just get the referral fees based on your deals with the brokerage.
Right. So you can hire purely admin people, or you can outsource some things. But what inside that corporation do you have to be mindful of if you're doing that would be different than you as an individual happy-go-lucky realtor now who doesn't have to do any of that stuff?
All right, so there's two things to consider, and that's is this individual an employee or a contractor? An employee, it would mean that you're taking deductions at source, T4 slip at the end, there's various labor rules and vacation pay to rely on. Contractor just gives you an invoice and they do their thing that you've directed them and you pay the invoice. It's really a question of fact as to whether they're an employee or a contractor. So if you tell them where to work, when to work, give them the tools, you assume the risk of the work they're doing, that effectively makes them an employee. However, if they're doing it for you and for 2 or 3 other realtors, and maybe they're doing some work for me or a small manufacturer, now you're not their main or sole source of income. It's more likely they're a contractor because they're not that dependent on you, even though you're telling them when and where to work. They're independent. You got to be really careful with employee versus contractor. The other things to be mindful of are the income splitting issue. So if it's a family member or a close family friend, you got to be a little careful with the amount you're paying them. But really, the real trick is it's got to be reasonable compensation in the circumstance if they're not third party to you. I would suggest a document outlining their responsibilities, whether it's an employment contract or a contractor's agreement, something that spells out the tasks that they will do. So when CRA comes along and says, what is all this? Here's the employment contract, here's the salary, here's the paid invoice. We give them everything they need. The trick with winning a CRA audit is, quite frankly, it's documentation, neatness and documentation.
Right. One of the other questions was, where are the business expenses being incurred?
I'm sorry?
Where are the business expenses being incurred? So I'm an individual realtor. All of those expenses now are going to go through the corporation, aren't they? Yeah. So I now can't deduct any of those things. My corporation pays less tax effectively because they are now taking those. Right.
So the expenses will be paid by the corporation. So, and if you lay out, a lot of the people we're talking to, are you still using their personal credit card? The corporations are new, don't have a corporate credit card, so they use a personal credit card. And then they can just be directly reimbursed by the corporation, supported by the vouchers and things that are the actual expense. So the expense should always be in the corporation. This should be, you should have a clean personal tax return if this is working properly. All that should be there outside of any outside investment income you might have would be a T4 slip for your employment income from yourself, and a T5 slip for any dividends from your own corporation.
Right.
Did that answer that?
I think so, yeah.
How do you make a team? Somebody asked a question, how do you make a team under a PREC? Philip, I don't know that it'd be any different, how you make a team.
I mean, you can't do it under the PREC. You could still create your own team. So I can have the Philip Brown team, and each of the realtors would be paid by the brokerage anyways. So whether they choose to then also create their own personal real estate corporations to be paid by is up to them. From a brokerage level, it doesn't really change. If there's 5 people on your team, I'm cutting 5 checks anyways. It now will only change based on the name on the check. It's either going to be their personal name or it's going to be a corporate group. Yeah,
I agree. It's otherwise it's black and white. It's black and white. Somebody asked the question, the tax rate on a dividend. It's less than your personal tax rate. Let's call it around 30%. I don't have the exact number. It's not something I noted, but it's less than your personal rate. In the way I'm being a little ambivalent because the rates on dividends change depending on the type of corporation. You pay less tax on a public corporation dividend than you will on your own corporation, but it's going to be 10 or 15% less than your personal rate. And if anybody wants that specific number, I can follow up with you.
Yeah. Somebody's asked about commission incomes coming in to the PREC, and once I've set up a personal real estate corporation, can I sometimes have commissions come to me personally and sometimes to the real estate corporation? That's actually covered in the agreement that Bob discussed earlier, and it really is, it's an all or nothing. So the brokerage can't sometimes pay you as a registrant and sometimes pay your corporation. It's got to be all in.
Yeah, I agree. And you have to advise RICO of the name of the corporation and the start date. I think they need a copy of that 3-party agreement. And once that's done, I think at that point on, you're not bringing anything into your own hands. The other issue that's come up, I've had calls from a few realtors this week. They've got big deals that they've closed, the check is ready. Can they put it in the corporation? Or no, the corporation was not around when you did the deal and when it closed. Same thing if you've got a deal now that's about to close. If the corporation wasn't incorporated when the documents were signed, then doesn't matter. You cannot put anything into the corporation if it wasn't earned while the corporation was in existence. OREA apparently is putting out guidance on that, and I know for sure that CRA is keeping their eye on that. And they'll look at that for the first year of all PRECs, for sure. It's a huge opportunity to make some money for them very easily with a pretty simple audit process.
Yeah, great question. If I'm going to put the energy into incorporating, do I do it with a lawyer or an accountant or both?
Do it with a lawyer, because the lawyer's got to do the legal documentation. The accountants don't incorporate companies, but you should talk to your accountant and your lawyer at the same time, because you want to talk about the classes of shares or whether you have family members, and the accountant will have input into that far more than the lawyer. And the accountant will be the one that suggests multiple classes of shares. The lawyers don't even think about that most of the time. They say registrant shares and non-voting shares, 2 classes, but that's not enough. Yeah. So yeah, start with your lawyer, but I would say have a conversation with your accountant first. Say, I'm thinking about this, and then get a recommended lawyer. And again, watch those fees. If you're being charged more than $1,000 or $1,200 to do this, you're paying way too much.
Yeah, there's a really great question that I'm going to take for you, Robert. Somebody said, if I'm already logging all my expenses monthly, I'm great at keeping my receipts. Do I still need a bookkeeper, and why? That's not an accounting question. That's a real estate question. If you're paying a bookkeeper to do all this for you, you can take all of that time and lead generate and sell more houses. It's a leverage question. So, you know, $55 an hour to pay somebody to do it, if you could be making $1,000 an hour in that same time, it's a great return on investment.
I agree with you. And that comes up every time I'm advising or counseling small corporations, small businesses. They always say, why should I pay a bookkeeper? And I have that same answer. If you can get a bookkeeper to work 3 or 4 hours a month or 8 hours a month for you, that's a whole day that you have to build your practice, to do some marketing, go take some PD. Do not waste your time doing bookkeeping. Now, most realtors are able to keep a neat shoebox, but this is a whole different can of worms than a neat shoebox.
Yeah, for sure. There's another question. If there's another family member who also has a corporation, can they be a shareholder in mine? And the answer on that one is they cannot be a voting shareholder.
Yeah,
So,
and it's a good question whether their corporation can be the shareholder, and likely it can. I don't know for sure, but likely it can. But again, non-voting shares. Because the rules are, you can also, as a realtor, have a holding company, as long as you directly or indirectly control the voting shares.
that's
So
right.
I would think that, and because we can have a children's trust as well, I would think that you could have another person's corporation, family member, hold those.
And I think that's the key, is that it would need to be a family member. They've been very clear in the legislation that that's their criteria.
And that's the
So
same for all professions. It has to be family members if they're allowed to.
So this hasn't been asked yet, but I know it's come up in discussion. The idea that jumping into this and now being a salaried person after having been, you know, kind of self-employed for a long time, seems like you know, it's got lots of advantages. Can you talk to some of the challenges with that for things like people's personal financial plans, if they're going to be trying to get mortgages, what you do now that there's a corporation that doesn't have a background, and now that you're maybe salaried on a much lower level than you used to be?
Yeah, excellent question. And I'll tell you, a real world problem came up last night. I was with a client, and he said to me that he's changing residences, selling a house, got a new one he's buying, and the mortgage company is only going to look to his personal earnings, not the PREC earnings. Now, that kind of bothered me because that PREC has got all that income. It's available to be taken out to my client, but the mortgage company was TD, said, no, only personal income tax returns, personal assessment notices, personal income. We're looking for your ability to pay. Now, I would think that there's some flexibility in that with some of those second-tier brokerages, say Dominion Lending, some of these other corporations. I don't know that the banks are going to take that flexibility. But if I look to, say, a regular small business corporation that is, say, a manufacturer, distributor, and has got a bunch of employees, same thing. He's got his salary and he's got his corporation. The bank is looking, quite frankly, to his income and a corporate guarantee if they're going to allow some flexibility. But I think your bigger point is long-term planning, not a mortgage. So long-term wealth planning, you'd have to now split your income. Say you made $300,000 before in your own hands. Now you're going to take out 150 personally because you want to max at RSP, 150 in the corporation. You have to have a wealth plan in the corporation, an investment plan in the corporation as well, because that's where all your income is now in two pots. So before you were doing it all in your own, now it's between the two pots. You have to work with I'm presuming most people with good earnings are talking to wealth managers or wealth planners. They're not just throwing the money off into the ether and hoping it lands in a good mutual fund. So this is a discussion that you have to have with a wealth advisor. Once you've determined your salary, dividend mix, how much you're taking out, you'll have a sense of what's retained in the corporation. And I know it's really hard to predict, but if you look at your last few years, kind of get a beat on what's going on this year with our COVID environment the next few months. Trev is talking about things being lower. I saw Phil from Royal LePage was talking about things being lower. He gets a lot of publicity, that guy. And he's got good PR, Phil Soper. Anytime there's a real estate matter, he's in the paper. He's paying good fees for PR, I think. But they made the comment that we've had this recent boom, but now they're looking at only 11% increase and an 8% increase. So it's hard to predict what your income will be. But that's no different than it was before. When you're making a wealth plan, you didn't know what your income is going to be for. So you still don't know what it's going to be. But to that point, Philip, you divide up your planning between you and the corporation. So you accomplish your goals and your needs. And that's a big issue, because how you determine your salary and how you get comfortable with that is going to be the biggest burden initially. And it may mean a lot of people rush into it and don't know what to do. And it may also mean that some of the realtors that should be incorporating are sitting back going, wait a minute, this looks like a bit of a burden. I'm not sure. I got a big check coming in now, but I don't know what's going to happen in the fall or the winter or the early spring. How do I figure out salary? So that's, to me, the biggest challenge. But it's no different than the doctors or lawyers have, because they also have inconsistent income. The lawyers don't know. So it's the same challenge that all small business owners face in their corporation. How do you determine what to take out? And it's an easy question, but everybody's personal needs are significantly different. So you need to consider this. If you put all the money in and take all the money out, just don't bother. Just don't bother. Now, but we run into the conundrum that you have a bad year this year, next year's a good year, where you look back and say, I should have done it. I mean, if you've had a history of really good years, I'd say within the next year, think of incorporating and then, play it out for a year or two. In the end, it's got to be beneficial if you're earning significant income. It's got to be beneficial.
Right. But it sounds like the message continually is, as long as you have the right leverage. Yeah. Because if I'm a single agent and I don't have an admin person and I'm running around 60 hours a week doing great sales, I'm also onboarding a whole lot of monthly and quarterly administrative tasks that I didn't have before, that are now going to be potential penalties if I don't do them on time.
Yeah. That's where the bookkeeper comes in. And I would have put a lot of these tasks onto the bookkeeper. Your admin person may not be a bookkeeping person. They're more a realtor administration person, which is the skill set that you need. If they happen to know how to do bookkeeping, that's a bonus. But there are bookkeepers around that are very helpful. We work with 3 services now that are as good as any. And I've gone through lots of bookkeepers. They're usually terrible. They get the books to balance, they go home. But that's not the end. I mean, they got to make sense, right? The books have to make sense. We're working with 3 services now that they seem to be competent. We got no complaints right now. I say right now because once one of them's overburdened, they'll drop the ball. Somebody will complain. But yeah, the bookkeeper is a key asset that you need to stay engaged with. Right.
So Bob, if you're at kind of the on the senior scale of things, and you've done all your RSP contributing that you will probably do. And now it's not necessary, from a big picture point of view, that you take a huge salary. Can you take all of the money you need in dividends?
Yep, you can. And if you're a senior and over 65, you can take an equal amount or greater amount, depending on the situation, to your spouse or partner over 65. No limit. So
okay.
The advantage there might be you pay yourself a minimum salary, say the 15 grand or so, that's tax-free. You have your spouse do enough work to earn a $15,000 salary, $1,000 a month, that's tax-free, and do the rest of it in dividends.
Wow.
Yeah, there's a lot of opportunity and flexibility. And the more money you have, of course, the more money you earn, the more opportunities there are.
Right. Which is not a bad thing.
Not a bad thing, but it is an administrative burden for the filings at the end of the year, the T4s, the HST, the T5s, corporate tax return, your tax return, and regular bookkeeping. It's a job. I mean, the money you're paying to people to do this stuff is they're putting effort in, so it needs to be done.
Is there an app yet that does all of this for us, Bob?
Yeah, it's called Robert Gold. Yeah, no, there's not one piece fits all. I mean, QuickBooks Online will take care of the bookkeeping, the HST, and a bookkeeper can do all of that. And then you work out salary dividend mix, and you'll end up talking to your accountant routinely through the year because your income's going to fluctuate, and you're going to say, I want to take out a special draw or special dividend or special payroll. Should I take it as a dividend? Should I bump up my salary? Do not become a stranger to your accountant once you do this. I mean, Philip, we talk now more now than we ever did.
Yeah, for sure. Awesome. Any other questions from anybody in attendance?
Go ahead, ask some questions. Otherwise, I have to go do real work, and this is far more fun for me. So let me give you my email again. It's Robert at Bennett, 2 N's, 2 T's, robert@bennettgold.ca. If you have any follow-up questions, I'm happy to answer. I'm not looking to be your accountant. I'm here just to share information, although we're always looking for new work. But I'm happy to share the Realtor Easy Tax Template. I might even be able to shove it in here. Can I put it in the chat box? I wonder. I might be able to. Should I try, Philip, and see what happens?
Yeah.
Let's see here. Where is it? Oh, I've only got an alias. No. Oh, here it is. Here it is. Let's just see. Put it in there. Did it go? Didn't go. Hang on. Drop it in. No, it's not taking it for some reason. Oh, well. Philip, I can send it to you separately, or I can send it, or whatever's the easiest, whatever people would like. If they want it, it's there.
Awesome.
I'll send it to you, Philip, and then if people want it, it's easier. They know how to reach you.
Yeah, send me your contact info. Send me the template and the contact info for the lawyer that you had mentioned earlier that does the whole package.
I'll send you the speaking notes that I was working from, because it's all there in case anybody needs to refresh.
We'll get that to everybody else.
And I'm very happy to take phone calls or emails, whatever. This is fun for me to help out any way we can, and I'd rather talk than work, so this is good.
That's amazing. Thank you so much for spending your time with us this afternoon, and we'll get all that info out to everybody. And thank you, everybody, for taking the time to learn this before you jump into some things and find yourselves in totally crazy hot water.
Great. Well, thank you.
Great.
I had fun. I appreciate the time.
Okay. Thanks, Robert.
Thank you right now, Philip. Thank you. Bye-bye.